All right. I'm going to kick it over to Jeremiah Allison, one of our ELG co-chairs, to get our program started.
Good afternoon, everyone. My name is Jeremiah Allison, and I have the luxury of introducing the moderator. However, before I do that, I will give a disclaimer that information shared by our panelists is for informational purposes only, and is not intended to be construed as tax or legal advice. Consult and investment or tax professional. So our moderator today is a dear friend of mine, and she will be the moderator for this installation series. Navita is an associate at Frederickson and Byron, part of the Merger and Acquisition Group, where she assists with a variety of M&A and real estate transactions, as well as general corporate matters by leveraging her previous experiences of working in-house at a nationwide franchise and seconded with a lending national middle market private equity fund. Prior to joining Frederickson, Navita was an associate at another Twin Cities law firm, practicing in areas of employment law, wills, trust and estates, corporate governance, and business transactions. Navita has graduated from the best law school, in my opinion, in Minnesota, Mitchell-Hamlin School of Law, and currently serves as a law school adjunct professor for the Law and Business Externship course. In addition to serving as a recruitment lead for TCDIP Emerging Leaders Group, Navita is also a co-chair of Minnesota's Women Lawyers Partner Leadership Council. So please do me the favor of giving Navita a warm welcome.
Thank you so much, Jeremiah. I appreciate that. If I ever need a ghostwriter for my biography, I know who to call. Thank you all for joining us today for our financial panel. We are so excited to have you, and we're more excited to have our panelists as well. We are joined today by four amazing panelists. We have Mary Joyce, Amran Farah, David Rosacker, and Justin Weinberg. We circulated their bios to you so you can have a little bit of a feel for their background, but in a moment here, I'll have the panelists introduce themselves. As Jeremiah shared, today's panel is all about that partnership track and the questions that you might be wondering but never feel comfortable asking. We're hoping to bridge that gap and shine some light and bring some transparency to as much as we can to the partnership track and the questions therein. So without further ado, I would love the panelists to introduce themselves, if they'll share their name again, their workplace, and if you're at a firm or at a CPA firm, sort of your practice area or specialty or area of your focus, and then your experience with the partnership path, whether you're a partner yourself or assist attorneys going through that process. Amran, why don't you start us off?
Ooh, always, you don't want to be the first person. So my name is Amran Farah. I work at the law firm of Greene, Espel, which is in Minneapolis. I mostly do complex commercial litigation, products liability, and employment investigations. I am also one of the firm's members and founders of our DEI practice. And so that dovetails really well with some of our employment law cases. So that's kind of what I focus on most of the day. And so I am kind of a newish partner. I became a partner in 2020 during COVID. A few months after I had a baby, I actually needed to make the decision of whether or not I was going to move for a partner while I was on maternity leave. And so I think, everything that kind of happened with me was unique. I think maybe my partnership vote was the first one ever done via Teams. And so it's been super interesting becoming partner, during COVID and thereafter. And also in the sense of like Greene Espel, I don't know, how many of you guys know about Greene Espel, but we're a full transparent firm. And so everyone had access. So I had access to our partnership agreement before I became a partner while I was just a member attorney. And so I was able to really make that decision, knowing exactly what I was getting myself into. Everything is basically an open door. So I knew, our capital contribution amount. So I knew everything that I would be getting myself into as being partner. Our firm is also, run by committee. So I am a member of our finance committee that also deals a lot with, what our bottom line is, what is coming in, what is going out. So that's been also super interesting, just understanding, what the firm is doing and being a partner and, feeling like, you're responsible for it a lot more than when I was just a member attorney. I think that is, I will leave it at that and probably talk more about it later.
That's great. Thank you so much, Amran, for joining us. David?
Hi, I'm David Rosacker. I'm a manager at Baker Tilly, a CPA firm. We here on our team, we work with kind of the private high net worth space. So a lot of my clients are attorneys. Throughout my kind of 10+ year career, mostly worked with attorneys working both in the US and abroad outside of the US. So I have a lot of in-depth knowledge with counseling attorneys as they make that transition to being an employee to a partner and how that impacts their tax situation.
That's great. Thank you so much, David, and thanks for joining. Mary?
Hello, everyone. My name is Mary Joyce. I'm a CPA with a firm called Friedman and Huey Associates. We're a mid-sized Chicago-based accounting firm. We work with clients all over the country. I am a senior manager, so I'm not yet a partner either. So I kind of am in the same boat as a lot of the people on the call. I do work with a lot of attorneys, and I love kind of going through that transition of going from employee to employer, I guess, and working through all the transitions that are involved with that transaction. We do work with a lot of high net worth families, businesses, foundations, trusts. We do it all. And it's nice to be here with all of you today. Thank you.
It's nice to have you, Mary. Thank you. And Justin?
Thank you, Justin Weinberg. I'm a partner at Taft in Minneapolis. My practice is primarily in the real estate space. When I am not practicing law or threatening to practice law, I also wear the hat of partner in charge of the Minneapolis office, and so do that. And my partnership pathway was a little bit different than Amran's. I was called in on a Saturday morning at my first firm where I made partner. They called me in after a supposed vote and said, "Welcome to the partnership." I had no idea what I was getting myself into, and so that has led me to trying to demystify this path, as you've all named it, and really help people try to understand, what am I actually getting into? Does partnership make sense for me? And if it doesn't, are there other pathways that I can still have a very rewarding and successful career? So I'm happy to be a part of this.
Excellent. Thank you for joining, Justin. So with that, I want to jump into our program here. In an attempt to hopefully frame the conversation, one of the things that we've talked about is moving and making that transition from associate to partnership, and a little bit of a change in mentality. So I'm hoping that the panelists can shine some light into what this change of mentality really looks like. And when we think about thinking like an owner, what does that really mean for associates making that next step?
Sure. It's one of the things that we talk about, quite a bit when we're talking to associates, usually in that 4th, 5th year, and as they kind of move through and coming up into the partnership side of things. But there really is a shift in terms of how you have to think. As you're thinking as an associate, you want to do good work. You want to be a team player. You want to help with the collaborative culture and culture building of the law firm. All those things stay the same. And you also have to get your hours in, right? Not only do you have to do all of those things, but now you also have to worry about, how is the firm doing? How are we doing from, a leverage standpoint? What are we doing, in terms of looking at the bottom line and making business cases as we go and make certain investments? And then also understanding, really, when it comes down to the end and you're talking about coming to the pay table, it's not just all about you. It is about your partners. It is about the partnership. And so you're rooting for your partners to do well and for the law firm to do well, because if that does well, then you'll also do well from a compensation standpoint. But then also, knowing that you may have to take a step back from a comp standpoint, even though you did everything right, because you are now a partner with other people. And so your success rises and falls a lot of times with the people that you may be practicing with. And that goes for 3-people partnerships to 800-person partnerships.
That's
Yeah,
great.
maybe.
Go
Oh.
ahead.
I think that shift in mentality, usually, again, different firms have, different partnership tracks. So it might be 7 years, might be 9 or 10, depending on the firm's partnership track. But usually by the time that you're ready to become a partner, you already have this idea that, I should be bringing in more clients, I should be generating work. And then now you really see, it's like, the work that you actually bring in, what actually happens, how it makes the firm work. Again, Greene Espel is a little different because everyone had access to all of that information before they became partner. But I think it's, for me, the two big things was, one, it was kind of, a stamp of approval or some, the firm letting you know that we want you here as a partner for the long haul. And so, them giving their trust in me and confidence in what I was doing also put a lot of pressure in wanting to, put out good work, wanting to bring in clients. And so this added pressure. It's like you get married to the firm and then now you actually, you can't just break up tomorrow. And so I think it's one, this vote of confidence that you're really getting with the partnership, and just a little pressure it puts on you as a new partner, but also having this really mentality about ownership. And so understanding that, you are a part owner of the firm, and that means that, you, like Justin said, you go down with the ship, basically.
I think Justin and Amran explained that really well. But it really is a change in mindset. You have to start thinking about different things. Do I want to be here for a long time? Are these people I want to work with? Is this a good investment in both my time and my money? Before it might be, hey, I'm really looking forward to that big bonus at year end. Now you have to think about it. Hey, that bonus might be lowering the amount allocated to me at the end. It's just a change in mindset and a different way of thinking about things.
That's great. Thank you. So I guess on the flip side of the coin, we've talked about this change in mentality and starting to think like an owner. The reason we're here today as well is to speak about the financial shift. So when you are making that shift, or if your assisting attorney is making that shift, what are some of the big picture things that you're seeing in terms of a shift in finances?
Anybody know, raise your hand. I know we can't see you. If you know how much benefits actually cost, not the amount that gets deducted from your paycheck if you're an associate. You will find that out when you become a partner. The differential is not, whatever it is, I don't know, but, you find out what that full cost is on the financial side of it. And so think about your own clients and people that you work with who own their own businesses. There's a massive shift, in terms of the things that you end up having to pay for. Even if you're at a firm that says, well, we pay for partner benefits, all that's really doing is just spreading out the cost of the partnership benefits across the board. So if you're a really heavy user of benefits, that's great for you. If you're somebody that's not a heavy user of benefits, you're picking up the load for other people. A lot of other firms will do it where you're paying your own way. So you pay for your own benefits, you pay for your own other side of FICA. That number's double, by the way. There's the employer side of it, as well as the employee side of it. So you start to kind of find out some of those things and you say, well, why is this a good deal? And I think it goes to what Mary said too. Is this a good investment? Is this a good use of my resources to be paying for this? But you quickly find that piece out.
Yeah, I mean, I think for me, it was just the tax implications in addition to the benefits. So and you can get this, but before I became a partner, I did have the firm tell me how much benefits would cost, or at least, an estimate of it. And, I was on the healthcare of the firm, and then later was like, does it make more sense to buy healthcare somewhere else? And so just making those decisions and figuring out how much that cost. And so there's the cost of becoming a partner in the sense of, the firm is no longer paying for your benefits. And then there's the tax implications. You're not getting a W-2 anymore. Before I became a partner, I did my own taxes. I got a W-2. I went to H&R Block or TurboTax and did my own taxes. It was a little bit more complicated. And so I had to think about, doing taxes, getting a tax professional to help me with that. And so it was a different way of thinking about that. A lot of times, there's changes in draw or other compensation. I've talked to my friends at other firms. And so, how you get paid changes when you become a partner as well. And so, that is something else to really think about as well. And then I think we'll talk more about like contribution. And so it's just like there's all of the other financial things that come with it. And so you have to do a little bit more planning rather than just spending your paycheck as it comes and then hoping for a nice bonus at the end of the year. There's a lot more planning that goes into it that I never thought of before I was a partner.
Right, and I mean, I normally get the clients where they're just like Amran. They did their taxes before, now they're a partner, and maybe you live in Minnesota, but your firm may do business all over the country. Now there are other states you may need to file in. You're probably used to your employer withholding the taxes for you. They're probably not going to do that anymore. You're going to have to pay what are called quarterly estimated taxes, and you need to budget for those things. There may be a buy-in when you become partner that you might need to start saving for. There are also retirement plans. Sometimes, now that you're a partner, you may be able to save quite a bit more. You're not limited to the 401k amount. The other problem, though, is as a partner, you may be required to put in a certain dollar amount each year. And that might be more than you're used to contributing to your retirement plans. So lots to think about.
I think the one big thing to add on, especially as an equity partner or an equity shareholder, your compensation is probably not going to be consistent over the full year. It always just depends upon the cash flow of the law firm. So you can have certain months where you're not getting as much, or other months where you're getting a lot more in terms of compensation. And it really depends upon the law firm. In my experience, a lot of law firms make 40% of their income in the last quarter of the year. So it can be a little harder to manage cash flow.
Those are all excellent points, thinking about when your money is coming through the door and being more thoughtful about expenses throughout the course of the year, and the sort of things that we take for granted now, right? A lot of us employers are paying 50% of healthcare. That's all on your plate. So a lot of considerations there from a financial aspect. Thank you for sharing that. Moving on now, I want to talk a little bit about structures. And I know it's going to be really hard to narrow this one down because they vary across the board. But are there some big picture structures that you're seeing when we think about what partnership might look like? Why don't we start with David on this one? What are some of the types of structures you're seeing, if you can point out a few?
Oh yeah, a very common one, especially as you just enter a partnership, is you become an income partner, where you're on your own for paying all of your health care and your employer's Social Security and employee Social Security, but you have a fixed salary for the year. So it makes that transition a little easier, where you're not kind of up to the whim of when the law firm brings in cash. So kind of a pretty good introductory stage of being a partner. And then from there, you can get promoted to an equity partner, where you generally have a share of the law firm earnings over the year. And with that, your compensation can kind of shift from month to month, from quarter to quarter. It really depends upon when the law firm brings in money, and also what law firm you're actually a member of. Every law firm is a little different in terms of how that compensation is actually set up. And I think the last type is generally a shareholder, where the law firm is a C Corp and you end up still having a normal W-2. So a little less complex in terms of making up quarterly estimated tax payments, but you still can end up having kind of the ebbs and flow of the law firm's earnings over the full year. You maybe get, let's say, 50% of your target comp as salary for the full year, and payouts either quarterly or biannually to make up the rest of your target compensation.
That's great. Thank you, David, for setting that up for us. Mary, anything else that you're seeing or anything to add to what David shared?
No, he did a great job of covering the different types, but the big thing to add is every law firm is different. Some have income partners, some only have equity. It's probably a good idea to ask, what does your partnership do? Do they have both, just one, the other? Are income partners still W-2 like you're used to, or do you have to buy in? There's all different types of structures, and it's a good question to ask ahead of time.
Amran or Justin, can you speak a little bit more? I know you've touched on this, but can you speak a little bit more to what your structure looks like and, sort of the early questions you had when you were learning about this structure at your firm?
Go ahead, you can start.
Okay. So like I said, Greene Espel is a little different. So actually everyone, partners and non-partners, have some equity in the sense of we don't do just a bonus at the end for non-attorneys. You get points at the beginning of the year as part of the compensation process. Everybody's allocated a set amount of points, and those points are tied to how much the firm makes at the end of the year. And so no one really knows how much money they're going to make at the end of the year because it depends on how much the firm makes. So if you come in a year like I did and the firm made way more money than they thought they did, I ended up getting more money than I was allocated for my compensation as a non-partner member. And so there is that idea from the beginning that you have some stake in it. The more money the firm makes, the more money you make. And it's really obviously a selling point for young attorneys to come in and without having, the points aren't so much that you're going to make less money. It's usually an upside for most of it. And then the other big thing structurally, we are a partnership. I'm not a shareholder, and so I don't get a W-2. And so there's things with that as well. The draw was another thing. I think most places have this, where you get a percentage of your salary throughout the year. And so you get to kind of pick, and there's limits to how much you can draw as a partner. But you can say, hey, I want to draw X amount for the year. And so regardless of where the firm ends, there's no way that I'm going to have to pay back money or anything. And the other thing I'm trying to think about that is structurally maybe different than, a shareholder or other partnerships is, the way different firms do capital contribution. Some firms you have to pay the capital contribution up front. Other firms let you pay the capital contribution as you go. Greene Espel is one of those that you pay into the capital contribution as you go. And so you don't have to necessarily make a payment, or I think some firms you take a loan out and then you pay back the loan throughout the time while you're there. And so probably once Justin talks, I'll think about some of their things.
No, that's a good point. And something to come off of me. The first firm that I was a partner at was a true limited liability partnership, and we had no target-based salaries. You were just basically paid if and when there was money from the law firm. I didn't get paid for my first 2 months, so that was super cool. To get that, and then my draws, except for 4 times a year, were half of what I was getting as a associate. So that really had some budgeting constraints, and I had to stroke a check, which I could get a loan for, and the partnership guaranteed. So it wasn't really hard. I didn't have to save for it. The way we do it at Taft, we are actually all equity partners. We only have 1 tier of partnership. We are a partnership. However, we've elected to be taxed as a C corporation, which means that we all get a W-2 wage. So we have targeted base income. And what I always tell everybody, and this is whether you're at Taft or somewhere else, if you're getting a targeted base, that is your starting point. You don't know how much you are going to make in 2023 until December 31 of 2023. I can tell nobody how much they're going to make at this firm, because that is all dependent. It's how everything helps. So targeted base, all that really does for you is it goes to David's first point. It helps you spread things out from a budgeting standpoint, because you're going to get a guaranteed amount between January 1 and December 31. But in terms of total comp, almost every partnership and almost every law firm, no matter which way you cut it, they really don't know what they're going to get paid until December 31st or some other date that's based entirely on the firm's metrics from the year before. So, you know, until the books are closed, you really won't know.
I have a follow-up question, sort of a threefold question about the draw. So and this again, big picture, just sort of trends that you're seeing. Are attorneys who are on this draw system, are they taking a draw comparable to what they were, say, their last year of associateship? So it's comparable within last year of associateship, first year of shareholder. What does the frequency of the draw look like? And is it tied to origination? I believe this was one of the audience questions as well. Or is it generally tied to some sort of expectation of where the firm is going to land at the end of the year?
That's a good one. Mary, you want to tackle that one?
Yeah, I mean, I see the biggest law firm we work with, and we have probably 130 clients through that law firm. It usually the draw is similar to what they were making the year before. I believe they get monthly draws. So, you know, they might get a certain dollar amount every month. Then they also get quarterly draws, which are basically supposed to go towards your taxes. So you shouldn't, the quarterly draws are really going to be used up by most of your taxes. It's not going to be actually spending money. And then towards the end of the year, usually they kind of have an idea of the number at the beginning of the year, but it's just an idea for estimate purposes. And then by the end of the year, that number could change drastically up or down. Because, you know, in January, February, you have no idea how the company is going to do throughout the year. Once you get closer to third quarter, it's more of a better expectation, but it could change drastically throughout the year. And maybe those draws are smaller at the beginning of the year and then they'll go up, or maybe they'll be higher at the beginning of the year and then go down. You can't really rely on them like you could a regular paycheck.
So for Greene Espel, we have a compensation retreat. Everybody knows how much everyone gets paid. And as part of figuring out other people's comp, you get this partnership bump, or, you know, this idea of, hey, FYI folks, this person is going to become a partner next year. They're going to have to pay this much in, you know, benefits, just so you know when you're kind of figuring out their compensation. As far as and then everyone votes on a compensation, and there's an amount, and then there is a percentage of draw that partners can take from that amount. So for us, that percentage is set out. I've seen places it could be as small as like 40% or maybe as high as 70%. So it depends on whatever your compensation is, and then you get an amount. You could, and I think a lot of places will let you take it bi-weekly, so you don't have to sometimes take it a month. Greene Espel, I can elect to take it every 2 weeks, just like I would a paycheck. And so it's like just the same amount. Instead of getting it once a month, I can get it just like a paycheck, and it's easier for me to kind of, plan for my expenses. We don't have origination, and so it's not tied to origination at all, because origination doesn't exist. So I have no idea if other firms treat that differently. But there's basically a big pot, and everybody gets allocated a percentage based on points, and it's less on origination because that doesn't exist.
Yeah, it varies wildly. I mean, as Mary pointed out, and I think the one thing to ask as you're thinking about this in terms of variation is it is a fair question to ask. How do partners end up getting paid, and is it a draw, and how do you base those things? And even when you're moving on from that transition from associate to partner, how are you going to base it? Where are you going to put me at? I mean, we don't ever ask anybody to take a big step back. So we try to base the economics and make sure you have a practice that's economically ready to be a partner as well. But really the amounts that you're going to get paid throughout the year, even if you have targeted base and everything else, is ask your firm how they budget. Because if they're budgeting really, really hot, I can tell you that draws are going to look like this. If they budget which might be great on these, not so great on these months. If they budget conservatively, it's going to be pretty steady until the very end, and then this huge spike. But again, I think that's a fair, question to ask is how does the firm budget in terms of how it pays its partners?
Excellent, thank you. And then just while we're here talking about contributions, and again, high level industry trends, are you seeing certain levels of contribution amount, whether it's like 50, 100, is it very dependent on market? Or is there a better way to take a temperature of what you should expect for contribution in your local market?
It is all over the place in Minneapolis. I mean, everywhere. Some of them are the ticket to ride system. So you basically pay $1 to get on the bus. You ride the bus, it's a bunch of profits, and then you get your $1 back when you decide to leave the firm. The way we do it is a capital contribution that's tied to a capital count. And generally speaking, it averages out to be somewhere between 35 to 40% of your total base compensation in terms of the total amount of equity, but that's contributed over a period of time, and you do it throughout the entirety of your partnership. So you're not required to write a check, and we take out the amount from your targeted base income on the basis of where you fall in the income stream. So our very new partners, they're typically only contributing 1% of their income to this capital contribution or to this capital account. So we don't create a financial strain. The higher income levels put in more, but you also then get that money back. So it's a little bit different. So when you leave the firm, you not only get that money back, but to the extent the balance sheet of the law firm grew as well, you would get any accretion that you might have to that. So it effectively works like a deferred compensation model or something like that. I know that there are shops, here in town that I've heard, as low as $10,000, and the highest that I've heard is $125,000 that ends up getting paid over, I think it's a 15-year period. So it's like owning a boat. Pay for it forever.
Yeah, I mean, the only thing I can add is having talked to, younger partners, I think the idea of writing, a $75,000 check or $100,000 check is probably not typical of a lot of firms, at least in Minneapolis anymore. And so I think a lot of firms are moving towards this idea that you pay into a capital contribution while you're there. I've joked with some of my friends, like Gen Zers, I could see, my little brother and them saying like, I'm not paying anything. And so I think, law firms have to really think about generationally what will make sense. If my firm asked me to make a 6-figure check at the day I became a partner, I would have been like, I have a lot of student loans. I could write a check to the IRS. And so I think, it's this idea of trying to make it work. A partnership, becoming a partner shouldn't be something that, that is a big financial burden. I think a lot of firms are thinking about, obviously, the firm needs money to work, but I think firms now are thinking more about how to make it easier for newer attorneys, newer partners.
That's great, thank you. Mary or David, any trends you're seeing as you're assisting your clients?
One trend I'm seeing is there's either a buy-in, and usually if it's a larger buy-in, the firms are willing to work with you. Sometimes you can get a loan through them, or they have a bank that they use to help you get a loan. And the interest you pay on that loan, by the way, is usually deductible against your partnership income. The other thing I'm seeing is one firm, they do like a buy-in where you're not necessarily buying in, it's just you're not going to get a raise for the next 5-10 years, whatever it is. So any raises that you would get go towards that buy-in instead of raising your income. That's another trend I've seen.
I definitely agree with what everyone's said. It really depends upon your firm. Every firm is definitely different. And a lot of the time, if you're just an income partner or kind of just a partner in name, but not part of the equity, there may not be an actual buy-in.
That's great. Thank you. This one is for Amran and Justin. And Amran, I think this one might be a little bit different for you because you're at such a transparent firm, but put yourselves in someone's shoes. They're a mid-level associate coming up on that senior associate level. What sort of questions should they be asking to determine, what type of structure do I have at my firm? How should I prepare for that? What are some questions associates, mid-level, senior level, even junior should be thinking about?
It's funny, when we were preparing for this, when we were thinking about this and going through it today, I felt a little bit bad about saying, well, it depends, because a lot of you might be thinking, that's all you're saying is it depends. I'm not getting any answers, but you're actually getting really good answers. And the answers are the questions you should be asking. And these are the questions that you should be asking, the questions you should be asking of your law firm, because those will be the answers. And if you're thinking of transitioning, going to a different law firm, or you're coming out from in-house and going into one. These are all the questions that you should be asking. I will tell you that the one question you should not ask is like, if somebody comes and asks me about the partnership, I am happy to share about the partnership. Don't ask me how much money I make, and don't ask me how much, our managing partner makes, for the overall firm or something like that. So those are the things that, just seem like they should be very Midwestern anyway. Nobody likes to talk about how much money they make. And so those are the things. But I think the questions really are, how are you structured? And whether you worry about it being a C Corp or an LLP, that doesn't matter as much. But it really matters of what are your structures of partnership? Is it equity? Is it income? Is it one tier of partnership? And those are really the questions to be asking. What, if any, buy-in is there? And that is, a really important question. And these are questions that no firm should really have any issues answering, because they are, just table stakes, and really should be telling folks, on the front end, what these things are. And if anybody goes to their law firm and said that Justin Weinberg from Taft told me I should ask these questions, and then they call me, I'm being recorded, so I can't deny it. But I will then say, yes, you should be asking those questions, because your associates deserve to know that, because they have a pretty big decision on their hands in the next 1 to 3 years. And, we're a relatively small community. And so, we want people to be fully informed.
Yeah, I joked during the prep of this that it is very Midwestern and kind of maybe very American, where Americans never talk about how much money they make or their politics, but talk about everything else. And Somalis talk about easily their politics and how much money they make, but keep other things to themselves. And so it is also where you're at. And so, but I think to what Justin said, ask about the capital contribution, how that's structured. Another thing he said earlier is how do they budget, because that matters as well in figuring out. You can talk about holdbacks, how that is structured, how that works, if there's any limitations, and when you can take, like how you would be able to get paid, what different options you have. Tax implications, obviously you're gonna have to talk to your own tax person, but if there's gonna be changes from when you're an associate to when you're a partner, as far as how you're taxed, then they can give you some information that you can take to your tax person. Draw differences, that's another thing as well. And just the process of when things happen. I think most firms, it's like, does it happen January 1st and so forth? And like, when is the comp meeting, and when does that go into effect? And whether or not the firm will hold your taxes for you and pay you out, and that's whether or not that's an option. And so thinking about once you know a little bit, then you'll have more questions, but you have to start the conversation to really know what your firm does and where you might need to make some decisions.
The other thing too that I could want to add to the piece of this too is ask your firm if you're where you're at to be partnership ready, in terms of, do you have a partnership ready practice? And what I mean by that, law firms still, we've taken the approach of, if it's not broken, don't fix it, right? We can argue about that. That's a different seminar, but it's hours rate. It's pretty simple. And so, do you have the hours? Are you in a practice area that has a rate that is supportable relative to your partners, because almost every law firm I know, with certain respects, it's all based on productivity, whether it's productivity of the individual partner or productivity of the law firm. That's how you get paid. No firm has figured out how to grow the money tree yet and just dole out dollars. And so, at the end of the day, I think that's a fair question to ask, and one that you should be asking as you're ascending and getting closer and closer to making that decision, because it may take you a year or two to decide, is my practice at a point where it would be partnership ready? And if it's not, what are the things that I need to do in order to get there? Because that is going to be a big driver for the majority of firms. They measure individual productivity. And if you have low hours, but a high rate, it might be great. You have a low rate, you might need more hours, because it's what I like to call, with CPAs on the line, especially dumb lawyer math. I can do that, so rate times hours without a calculator, usually, as long as it's only zeros and not too many others. So.
The last thing I'll add, and this has less to do with finances and more just the process of becoming a partner. I think understanding the process and how long it'll take, when the decision is usually made. I think one thing that I thought of, there's usually, when the partnership vote is happening, there's a lot of narrative around you, your hours, and so just understanding what goes into that and really like setting yourself up. You're a product almost at that point, and understanding, like, Justin was saying, are you a product that's ready for partnership? And like, what can you change? What are people thinking about? You don't necessarily want to go in there blind. You want to have as much information going in, so you can set yourself up. There is, I've seen other people at other places where they move for a partnership when they're not ready, and a narrative develops around them, and then that hurts them in the future.
That's great. Thank you both. Now, Mary and David, I've gone to Justin's office. I've asked him all these great questions about the structure and partnership at their firm, and now I'm coming knocking at your door. What recommendations do you have for associates from a tax perspective? What questions should they be asking?
I think the big thing is find an accountant that works with maybe some of the other members or partners at your firm, because they'll have a better understanding of kind of what the tax impacts will look like over the next couple of years. It's generally, anytime I'm talking to a new law firm partner, I want to counsel them for, here's what to plan for this year and here's what to plan for next year. It's a lot easier to kind of get your cash flow in order when you're looking at the front windshield and planning 2 years ahead. Everything might not be 100% exact, but as long as you can kind of start on that right foot, it makes that transition into being a partner a little bit easier in terms of your cash flow planning. And then maybe also looking at, do you need to file other states? Are there other states that you maybe need to worry about that you weren't when you're an employee and just filing a federal tax return and a Minnesota tax return? Or even what you should do in terms of retirement can also be something to consider.
Yeah, I totally agree with David. Like I said, I work with one law firm and we have about 140 different partners at the same law firm. So when I get a new partner, it's so easy to tell them, okay, this is what year one's going to look like. Your income is going to be actually down a little bit because they're a fiscal year. And then the next year, that's when you're going to owe the big money because it kind of gets deferred a year. So yeah, I mean, I would ask the other attorneys in your firm, who do they use as a tax accountant? Be prepared to have your current year tax return or the last tax return you filed ready for the new accountant, because we'll want to look at, we start with, where are you now? How much money are you making now? Okay, and then we'll shift into, now you're a partner, what does that look like? And as David mentioned, you might be filing in a lot of other states. We're going to need to do the quarterly taxes because you're not going to have withholding anymore, most likely. We might need to make those quarterly payments to other states as well. I see a lot of firms filing in like California and New York, things like that. If you're in a high deductible health insurance plan, you may be able to do something called an HSA, which maybe you haven't done that before. And that you definitely can save more for retirement. And there also may be a lot of other expenses that you weren't able to offset against your wages. But now that you're a self-employed individual, anything that you may be paying out of pocket that you're not being reimbursed for might be deductible. So it might be a good idea to ask your accountant, you know, what are some of these possible expenses? And you're going to need to start keeping track of those things in order to deduct them.
Mary and David, do you recommend that maybe associates in those firms where they're getting bigger bonuses, not wait until the next year when they're doing their tax appointment? I mean, to contact you throughout the year to see, check in, or?
Yeah, absolutely. I mean, anything that you can ask, like, for instance, if you're getting a bigger bonus, okay, now you have this big chunk of change that you're not used to having. It might be a good time to pay in a little bit extra while you have the cash. It's always a good idea to ask before these events occur rather than after, because if they've already occurred, there's no tax planning then. It's already happened. There's nothing we can do a lot of times, but if you know something's about to occur, if you ask ahead of time, there may be things that we can do to help you plan for those events or big cash flows.
That's great. Oh, go ahead, David.
Oh, I was just going to say, I definitely agree with that. And kind of another thing that CPA can help you with is determining when you can actually defer tax. Maybe you don't need to pay every quarter and you can defer without interest or penalty until the following April. A little more beneficial now that there's actual interest rates on bank accounts. May not be the greatest dollars ever, but you can actually get a couple extra bucks and not give the IRS an interest-free loan.
Right, as David mentioned earlier, a lot of these firms get a lot of their income later in the year. So if you're not getting that income earlier in the year, maybe you don't need to pay it into your taxes just yet. You know, you can make the smaller payments the first couple quarters and then the bigger payments later in the year. I see a lot of that on the bigger firms on the East Coast more than anything. But again, it's a question that you should ask your firm. Is the income earned equally throughout the year? Because if it's not early,
The first year as a partner, so.
The first year is the biggest year of adjustment. There's a lot of questions, and you know that's where you kind of want someone helping you navigate through all of the change.
Excellent. Now, we started today's conversation talking about some of the shifts in finances. Then we talked about some of the questions we should be asking, right? Like, how is your firm budgeting? Any other additional thoughts about the budgeting aspect of this? Are there any big differences that you saw, especially from that last year associateship to the first year partnership, in terms of how you change your budgeting?
For me, it's retirement. It's a lot different the way I kind of budget throughout the year for retirement. The first year I didn't necessarily understand, and I put away a lot more in retirement than I was planning, just because, you know, if it's just a percentage and you earn obviously more different amounts of money in the beginning of the year versus the end of the year. And so really think about when you're saying like you're going to allocate X amount to retirement, what that means. You can put more money in your retirement now once you become partner than when you're not a partner. And so retirement was one thing that I had to just really change how I was budgeting, just because, you know, I could put more money in there. And, you know, when I put that money in there beginning of the year versus the end of the year, and profit sharing. And so that's, you know, one additional thing that I didn't really think about. And it's not necessarily the first thing that people talk about when it comes to, you know, being a partner.
Yeah, I think that's a big one that a lot of people don't understand. I mean, and your 401k is your 401k. That's not going to go away. And what is it? It's like 20,500 this year or something like that for the 401k contributions that you can actually make. That includes, you know, employer matches and things like that. But then there's also, you know, profit sharing that you don't have usually a choice. As to whether you're going to be participating in that. You are voluntold that you will be participating in the profit sharing, and that is going to be based usually on a percentage up to the IRS maximum, which again, David and Mary would be in a better position to answer that. I think it's like 295 this year. So it's on the first 200, last year was like $285,000 of income is, you know, you could put away a certain percentage up to that dollar amount and max out I think last year was a total of $56,000. So a couple things. One, that's great, right? Because you are able to sock away another $36,000 into retirement on a tax-free basis. But if you were counting on having $36,000 to budget for your monthly expenses and everything else, you need to know that, and whether or not it is a mandatory retirement contribution or not, so that you don't end up getting stuck with that. And then when is that due? We pay ours throughout the entirety of the year, and we normalize that across 24 pay periods. The first firm I was at, it was paid every year when you filed your taxes. So that was also a super sweet $18,750 I got to write on April 15th on top of my quarterly estimates and the amount that I owed from the year before. So you should do it though. It was great. Don't worry about it. But those are the things we're telling you now, so that you don't get shocked by it.
Oh, sorry. The one thing they don't tell you is they just like send you this money that you're supposed to like give to the IRS. And then I was like, well, this is just like money now sitting in my account. Like I could go and do like travel with it. But no, you're supposed to be responsible. And I'm like, can you guys just send it directly to the IRS? Like if I see it, then I don't care. But like Justin's saying, like you have all of these payments that you are supposed to make to the IRS directly, in which you now should be a responsible adult and actually.
A lot of sticker shock is what I'm hearing. Though thankfully we have this session today to hopefully avoid all of that. We do have one question from the audience here. The question is, how did you know that partnership from a financial standpoint was for you? Or on the other side from Mary and David, like what are some of the considerations that your clients are making when they're deciding whether or not they want to move forward with partnership? And what questions should we be asking ourselves when we're making this decision? A big one.
If your firm has a holdback or any of those types of things, a lot of firms will have a holdback where they'll do a targeted income and then they'll hold some back, from a budgeting perspective. I think it's a fair question to ask, how many times has that holdback been ratably distributed or not distributed at all? And what that means is the firm didn't make budget. And so, how often has that happened? Or the other question to ask, in terms of financially, how is it doing? We, covered on how does the firm budget. Be a little bit careful on asking, did the firm make budget? Because I know some firms, to include the firm I was with, we revised our budget every quarter, it seemed like. So we always made it, and it was great. But it was different than the year before. And so I think, the question really to ask is, from a pure budgeting standpoint, in terms of where the firm is at, law firms run on pretty high margins. So there's usually always profit to go around. So the question really is to ask, at the end of the year, how has it been handled in terms of distributions? Are you making the distributions you expected to make? Are you making excess distributions? Or are you having to go basically on a ratable percentage? And if you ask those questions, that'll give you a pretty good idea without having to pour over the P&L statements, of the law firm in terms of a snapshot and whether you would do it or not.
The only thing I would add is, more philosophically to ask yourself, do you want to be a partner at this firm? Like, is this something that you're invested in? It's not something where, you're there for a year or two and then you leave. A lot of firms, I've talked to friends, how long the firm can hold your capital contribution varies. And so, some firms can hold your capital contributions for like up to 5 years or something. And so it's not where, you can just decide next year or the year after, oh, I don't want to be a partner anymore. And you're just walking away like a regular job. And so it is an investment from you and an investment from the firm as well. You think about the idea that you're not going to get all of your salary or your compensation at the beginning of the year. So if you make a decision to leave the firm in the middle of the year, then there's a lot of other things that come in. And so, the first question I think you should ask yourself is, do you want to be a partner at this firm? And do you see yourself here for 5-10 years? And if you don't, then maybe you shouldn't be partner. And it's not necessarily just because you're offered or it's that time. And so there is, there's a lot more intentionality that you need to make just because it's harder to get out.
Yeah, I would just add, it's not all about the money. I mean, are these people that you want to sit in the room with and make decisions with on a regular basis? What does the future of your firm look like? Is it a smaller firm and a lot of the partners are about to retire? Because if they're leaving, somebody else has to start bringing in those clients and supporting all the employees. I mean, it's not just a one-year thing. It's not as easy to change jobs as Amran had said. There's a lot more to consider. And the people that you work with and the clients and the future of the firm, I think all need to be considered. Because you're probably not just doing this for next year or so. This could be where you retire. You could be there for the next 20 years of your life. You don't see partners. I do see partners switching. And it happens all the time, but not as often as when you're an employee and you're changing jobs. It's a bigger commitment, I would say.
Excellent. Well, thank you all so much. We've got a few minutes left here. Do we have any additional questions from the audience? You can either drop it on the chat or raise your hand. Either one will work. Oh, we've got a question here. Okay, I'm just going to read this one out. It's a good question. So it says, how did you develop a sense of what is fair in terms of being enough, being equitable, generally being appropriate for your compensation as a partner, especially compared to others?
So could you if you just read that again? It's a really good question, but
yeah, it says, how did you develop a sense?
Compound, so.
Yes, it is. So I think it's about fairness and equity in terms of compensation. So how did you develop a sense of what is fair in terms of being enough, being equitable, generally being appropriate for your compensation as a partner compared to others?
That's a great question. And it really comes down to that compared to others, and a question that you should ask your partnership as well. How is partner compensation decided? Is it one person that decides it? Is it a small committee of just a group of people who've been there for ever and a day, and those are the folks that do it? Is it a large committee that has a constituency that's based on yours? And then is it so that tells you who's the composition of the people making the decisions. And then in addition to that, how transparent is it? Do partners get to see what the other partners are making? Because then that way you can, see, is it equitable? Is it fair as I'm being compared to others? I serve on our firm's compensation committee, as I did compensation for the previous firm before I merged too. I will tell you, I never had anybody come and say, like, you paid me way too much, here's more. But what I will say is that when you have a system that's fair and it's predictable, what you don't have is people saying that, yeah, I wish I would have made a little bit more. But having said that, I can see that this person, based on their metrics and how we measured those things, that it was at least fair. So that's a great question, and one that I think is a fair question to ask of how do you determine partner comp? And usually if it's going to be black box or there's a very few number of people that want to do it, or if you have people wanting to get on the compensation committee, that generally is a tell that, it's doing it from a protection standpoint. You need a friend in the room. So.
Yeah, I mean, I think, again, Greene Espel is a little different because it is transparent and the whole firm makes compensation decisions, not just a group. But what I've learned is, even based on the people who are there, how much of it is based on perspective, how much you can make versus, retrospective, like how much you made last year, your hours, your billables, your receivables as well. It's not just about you bill a lot, but then, there's write-offs or maybe there's custom fees, like what all goes into it. And just having that conversation with the folks who are making the comp decision and trying to really understand like how they see it, because it's not necessarily just, hours times time. There's other ways to think about it. It's like, okay, what kind of clients do you have? Is it where, clients who have low rates but give us a lot of work versus, clients who may not give us a lot of work, but we get A rates for them. And, it's some of it's just philosophical. Different people you'll find really think about, comp differently and think about, what people are bringing to the table in a different way. And so regardless of who's making that decision, the more people, the better. I would be scared if it was one person and I like piss that person off. But, you know, regardless of how many people are making it, it'd be nice to kind of know the way people are thinking about that. Even at Greene Espel, even though we all make that decision, we have to talk to each other. And, you know, some people may want to get paid more than we think, or some people are very humble and are like, no, you know, I think I'm fine, or, you know, I didn't have the year that I was wanting to have. And so there's a lot of other things to think about. There's bias to think about that, that comes in and whatnot. So there's a lot of things.
So I know we're right at our time, and I want to thank our panelists for all of the great insight and discussion today. We do have one other question. I'll pitch it, but if anyone needs to drop, feel free to drop. I want to be respectful of everyone's time. But the last question here is really about your spouse. So if you have a partner or spouse and you're up for a partnership, what were the conversations like in prepping your spouse for that financially, and what did planning look like from that perspective?
My wife asked me how much money I was going to make, and I said I had no idea. So she said, "Why are we paying this?" So that was really fun conversation. So we had hot dogs to celebrate and shared a bottle of Coke, but because we didn't know. Hey, that's a great question. I mean, it's oftentimes, you know, if you do have a spouse or, you know, other, you know, family unit that you're dependent on or is dependent on you, and or you're all dependent together, it needs to be a conversation, I think. And this goes to, you know, Mary's earlier point too. It's financially, it's about the money, right? You want to make sure that you know, and are you budgeting correctly, and how are we going to rely and budget out the finances going forward. But then also too, do you really want to be partners with these folks? Because that can take a big toll on the family unit as well, if you just really despise the people that you're partners with.
Yeah, I mean, I did not have a good conversation with my husband because I didn't really know what I was supposed to talk about. But I think this is a good conversation to also have with your spouse and your tax person at the same time. That way, you know, they can really think about, you know, what happens if your spouse changes jobs, or if they, you know, if they own a business versus if they're, you know, there's a lot of other what they do and what you do affects you guys a lot more, just because both of you guys are trying to do your taxes together at the same time. And so I would say, you know, have the conversation with your tax person, even if you can't answer all of the questions. And they may say, hey, have you guys thought about this? Which you guys probably haven't. We didn't.
Mary and David, it can have an effect too if you're filing jointly, can't it? I mean, in terms of pushing tax brackets, and if you're withholding, your spouse is working and you have a certain withholding amount, I mean, should you be paying attention to that?
Yeah, definitely. I mean, like, let's say you're making 200,000 and your wife is making 20. I mean, so the $20,000 employee is not going to have the withholding. You're going to jump into a higher tax bracket quicker, and that $20,000 salary is probably not going to have the withholding that it needs to be. So, you know, again, you're probably making quarterly estimates now. They may need to be adjusted for things like that. Other things that you might need to consider, like medical insurance. Now that you're a partner, you're probably paying a lot more for medical insurance for if you have a family. A consideration would be, can we go under the spouse's health insurance plan at their job? Things like that.
That's great. Oh, go
I
ahead.
was just going to add in that almost always it's more beneficial to file jointly with your spouse. So you can always ask your tax professional to kind of put together a side-by-side comparison, but almost always it's definitely ends in a better result for you.
I agree.
Excellent. Well, Mary, Amran, Justin, David, thank you so much for joining us today. I truly appreciate it. This has been a great session. I feel like we could have been here all day, and we've got through a lot of our agenda. So thank you so much for your time. And to the larger TCDIP community, thank you for joining us here as well. We'll catch you at the next session.
Thank you.
Thank you.
Bye.
Bye.